TheoTrade. This is Don Kaufman. September 16th, 2022. 30 minutes to go to the cash close here on this expiration Friday. Once again, some heavy sell side activity in the marketplace. But the real question is, are you prepared for the coming volatility shock? On this weekend's update, I'm going to take you very deep into some quantitative analysis that I think you should pay, careful attention to, because once again, we've got quite a number, if you will, of, the stars aligning for what could be, as I just said a moment ago, quite the little volatility shock to the marketplace. And I'm going to explain precisely what that means, how to kind of prepare for it, some of the implications of it. But let's get started here. First and foremost, to understand on this weekend's update, I'm not going to mention a tremendous amount about equity products. When I say equity products, obviously we could discuss Apple, of course, till we're blue in the face, which a lot of people are going to do. But I'm going to be very frank in saying that you start looking at like advanced decline line, and you're going to note that, we're not totally correlated right now, but we have been. And I'm going to tell you right now, if the S&Ps, which, as I said, have 30 minutes to go to the cash close, it's an expiration Friday. $3 trillion came off in the expiration this morning in the SPX. I mean, this can get downright wild. You got to focus right now on the bigger picture, and that is the S&Ps. And I think a lot of people are going to miss what is actually going on inside of the S&Ps, which could be, a complete and utter repricing, something I was actually talking about a little bit earlier in the week, on Tuesday after the CPI number came out. I'm like, look, this can be a complete and utter repricing of the marketplace, but there is some wild statistical aberrations going on inside of this marketplace, and I'm going to bring those to your attention. So bear with me on this thought, because again, we could talk about equity products till we're blue in the face, and sure, you can look, Google's actually completely breaking down. Meta has actually broken through some of the lows. You start looking at Microsoft, it's right up, butting up against the lows over here. Okay, everywhere you look, like again, the stars have kind of aligned in some of the equity products. That is not my cause for concern. So let's get started with this weekend's update here, specifically focused on the SPX. Okay, and I'm going to open up the scratch pad. And again, are you prepared for the coming volatility shock? That in no uncertain terms, like I don't want to have implications that we can only go down. Again, we're in a situation right now where there are a number of critical factors, including volatility, the bond market, the dollar, which align just beautifully for the S&Ps to get outright crushed. But the bigger concern right now, and probably the biggest concern in my mind, is volatility is just, it's ready to rock. And again, I'm going to explain that in quite some detail. All right, before we get there, as I said, to focus on the broader market, we're going to come back to the S&P futures. We're going to come back to the S&P futures because earlier in the week, and throughout the course of the last couple of weeks, I've been talking about 39.31, which is actually what we term a gravity point. So I'm going to start this weekend's update here on a 30-day 1 hour. There is one thing, okay, that is very, very relevant at this point in time, and that's this. Any trade that we've seen as of late under the gravity point, and again, I want to actually mark this up on the screen over here. Again, this is a 30-day. I want to clarify, 30-day 1 hour right there on your screen is that 39.31. Any and all trade that we've seen recently under the 39.31, it has been downright vicious. Now, the 30-day 1 hour, you're like, what? Come on, man. There was only a brief and fleeting moment. Yeah, you're right. Let's open up the 180-day 4 hour. It gets downright hideous under the 39.31. Precipitous drops in here, rally back to the 39.31. We've actually tested this level a number of times. And at this point, again, it's kind of like, hey, we're under it. We look like we're good to go. All engines go to the downside. But, again, frankly, I don't think that looking at the S&P chart, I don't think there's any credence whatsoever to looking at this chart and saying that, oh, it's trend down. Like there's no feel, there's no trend in the midst of volatility. And, to say that it's trend down, I could probably make the argument, yeah, look at the entire year. The entire year has been a hallmark of volatility. It's a little bit of a free-for-all. So I'm going to move away from looking specifically at like the S&P futures and trying to decipher, like what are you going to decipher in a trading day that looks like this? I mean, quite frankly, again, it's expiration day, yada, yada, yada. I got to tell you, got 25 minutes to go to the cash close. You know, people are like, well, we're going to rally back up. Yeah, right until we got dropped right on top of our head. It's a total free-for-all. Look at the contract size in here. And you start getting north of like 8,000 contracts. That's 8,000 S&P contracts a minute. You took a look at an S&P, you know, oh, don't worry, it's only like a $3,900 product that's trading 8,000 contracts a minute, right? That's a fire hose fully open, all right? And when that fire hose is fully open to go up, to go down, again, it's a complete and utter free-for-all, and you have to realize that, right? So this is all hedging activity. Everybody's just trying to cover themselves and cover risk, especially coming into a weekend where you don't know. There's a lot of geopolitical risk that's actually bubbled up over weekends lately. So push aside for a second what you think you see in a chart. And I really do mean that, like it's trend down. Yeah, until we burst back up to 4211. Again, the implications of me covering this on the weekend update is not to bear you up. It's to actually show you, again, really highly detailed in like specific areas, okay, of concern. Specifically my concern in this case where it's not often I say this, but I am coming into this weekend. I'm grossly underallocated. Got a couple positions in here, but I'm grossly underallocated. And like what does that even mean? Grossly underallocated? It means I've actually clipped a lot of my directional risk, especially when it comes to premium selling. When I'm sitting here, when I talk about my directional risk, okay, here's a TheoTheo portfolio. My SPY beta weighted delta is 1. Yeah. 1, collecting about $100 a day in decay. I've got another portfolio, and I'll cruise over to Tasty. You know what my delta is over here? And again, this is an ETF, beta weighted delta on Tasty. My aggregated delta in here, you're going to love this. Yeah, it's 0.02, collecting in only about $55 a day. But I'm just trying to make a point. Okay, I have wrapped my directional risk when it comes to premium selling very tight. Don't get me wrong, I'm still actually bearish in an overall portfolio, but those are longer duration positions. The short-term stuff, wrap my risk very, very tight. And I'm doing that because, as I said, it's not that I'm like fearful we're going up or going down, okay? I'm actually okay with that. What I want to do, though, is I want to reserve some capital at this point, okay? Again, not knowing whether we're going to have that explosive, volatility is ready to rock, explosive move down. I think there's going to be some phenomenal opportunities coming. And I want to make that very, very clear. Okay. But what's the fear? The fear right now is when volatility does explode, it is going to be absolutely fierce out there. And frankly, okay, I'm covering some of that risk because I don't want to get caught on the wrong side of again, a volatility burst. Let's get down to it. So as I said, it's getting ugly. Under 39.31. Newsflash, it has been ugly under 39.31. Next, if you take a look at the SPX, and this is really, really wild stuff. Again, here's another very pivotal reason that I've wrapped my risk extraordinarily tight at this point. Look at the number of breaches of expected move. I don't care if the marketplace is still open. Look at this. That's a breach of expected move. That's a breach of expected move. There's a breach. Okay, that's a 2 sigma breach. That's almost a 2 sigma breach. That is a 2 sigma breach. Here's a little one. Oh, it's a pretty decent one. This is a full-blown hideous move. I don't care whether we even rally today. You realize we were expecting a $97 move this week? $97 move. Where did we start the week? Oh, we started up near 40.70. Where are we right now? Oh, 38, we'll call it 70. I'm just rounding, okay? For argument's sake, we're almost exactly, if you looked at a distribution curve, okay, we're 2 deviations to the downside. We're actually outside of that. So it's wild and woolly. What's crazy about this, and again, one of the most intimidating things that I see on the screen, and again, it's making me like, I want to wrap my risk tight, and I'm a little reserved right now. I want to keep as much capital free as I possibly can for some opportunities here. The SPX is just screaming inefficiency. This is a complete and utter like breakdown, okay? And what the break is, again, I mean, how many times do you have to see these wild, 2 sigma type moves to start to recognize that the SPX is getting things wrong. The options marketplace that just had $3 trillion come off the expiration is getting it completely wrong. And that's not an easy thing to say. I think there's a lot of traders that would be almost offended by that, but what's the offense over here? It was expecting a $97 move, you had a $200 move. Okay, you don't need to be offended by it. You need to recognize it. And I'm going to tell you right now, it's because the marketplace is literally coming apart at the seams. Okay, the forward risk in the marketplace is not being well handicapped by the option marketplace, is what I'm getting at. You just break it down, if you will. When I say that the forward risk, what do you think an option market does? You take a look at the SPX and you look 7 days out. Okay, freeze the screen for a second here. We look 7 days out and we look, all right, 7 days from now, the market's anticipating $120 of risk. So that expected move actually picked up quite a bit, right? But at the exact same time, each and every week, it's like, hey, yeah, it was $120 of risk. And all of a sudden you move $300. You're like, ooh, got that one wrong. Like, how many times in a row can this happen? Can a 2 sigma move, okay, become the usual? And the answer is no. That just defies like all logic of the marketplace. When I say like a 2 sigma move, right? You're looking at a distribution curve. You look at this distribution curve and you think to yourself, well, 1 standard deviation. That is what an expected move is. An expected move this week was plus $97 or minus $97. To see a $200 move on either side of that, you got to go, what the? And then to see sequentially, oh, let's breach there, let's breach here, let's breach to the upside. The SPX is getting it wrong. Okay. And it's a little bit of a warning shot because in effect, what it's saying is that the volatility in the SPX, okay, is actually firing a bit too low. And maybe it's getting it right this next week. Okay. Again, only time will tell, but it hasn't been right much lately. I mean, this has been an entire, like, if you will, like, look at these 2 sigma moves. This has been, okay, basically the year of the 2 sigma move. And it's okay to sell premium, but you can't sell any short duration premium. You sell like weekly options, you're going to get killed out there, people, just annihilated. Again, 2 sigma doesn't become the usual. So one of 2 things is going to happen over here. We are going to have an absolutely, okay, violent move that actually is like shock and awe, that brings volatility up and up substantially, okay, to basically shock markets back into alignment. And then all of a sudden, we start in this more efficiency trade. We are really far from efficient right now, and it's one of the aspects that really resonate. And that's why I say I wanted to get a little bit more like quantitative. And I'm just doing this on the surface. Like, I don't want to get into the mathematics of like, hey, the marketplace is ripping apart at the seams. When I say like the market's ripping apart at the seams, they are doing just a piss poor job of handicapping forward risk. Who are they? All the market participants, you, me, everybody. Okay, markets themselves, like the actual price action in the SPX is moving way further than the options are giving it credit for. So my belief, okay, we have to actually get shocked, literally, okay, shocked back into alignment. So there's another way that can happen. And that is, well, the market could rally up and volatility can collapse. Yeah, but when the market rallies up, it's been rallying right through the edge. It's been rallying through the edge. It's been rallying through the edge. It's been rallying through the upper edge. Okay, it's just as ridiculous to the upside. I don't see another way out of this other than to have a big volatility shock where like a VIX spikes. All right, next in the docket, I say volatility is ready to rock. Obviously, I'm indicating that volatility probably is ready to rock. But when I say vol's ready to rock, I just want you to look at the picture on the screen right now. Here's the picture on the screen. If I were to freeze the screen, which I'm going to do right here, froze the screen, you realize the S&Ps are down 30 handles. Okay, vol futures. Now this is really short-term vol futures. They're not even budging. The VIX today is massively unchanged. I mean, it just kills me. But the volatility that I'm really concerned about, right now, when I say volatility is ready to rock, we're right up against it. And this is where we start talking about contango and backwardation again. And this is something I actually brought to light on Tuesday. Okay, we crossed over into a backwardation that is OCK versus NOV. We crossed over into a backwardation for a brief and fleeting moment. What I want you to see in this particular circumstance, okay, short-term volatility is 27.40. Now that would be the October volatility. Okay, no volatility is a hair higher at roughly 27 okay, we'll call it 60. So there's a very, very mild, okay, 20-cent contango in here. So what's the cause for concern? You do realize that if this AUK just slips a little bit higher, let's get crazy. Let's say it goes up to 28.50, and this little nove over here only goes to 28. All of a sudden, you slip then into what's termed backwardation. That'll change the way you feel about this marketplace in a hurry, because then lots of firms are going to go and they're going to sell S&P futures to reduce risk, okay, of October exploding in their face. So again, such a mild contango that you got to be concerned about this into early next week. You have to be concerned. And if you're not, you don't understand this, basically what I'm saying is, hey, when we go into backwardation, that is when AUK comes over NOV, it's like a small explosion in the marketplace, and everybody actually rushes the S&Ps to mitigate their exposure. So volatility is absolutely ready to rock. On top of it, you get these constant 2 sigma moves, and you need that volatility shock to get the market kind of equalized again. The implications of volatility spiking, I mean, again, the implications of the volatility spiking is, okay, when we go into that backwardation, one of the primary hedges is trading firms start selling S&P futures to mitigate their volatility exposure, okay? And to further that, it would also imply, and again, I am implying that if we're to see that little volatility shock, the VIX is going to go parabolic. You'll see VIX in 34, 35 region. You got to realize that we're down there, people. When I say we're down there, I mean the last time the S&Ps were trading, down in this level for a considerable period of time, VIX was back up in the, mid 30 region. This is at least in the 30 regions over here. And the very first time that we actually, cracked some of those lows, I mean, the VIX really spiked up there to like 36. Okay. And that's the kind of thing that we're just, people look at this and they go, it's very complacent. It's not about complacency. It's about the fact that the VIX learns. Like volatility, is rather smart. And I always use the same analogy. You see a really scary movie, you're like, the first time. You see the same scary movie again, you're like, lady, don't go in the closet. He's going to kill you. All right. By the third time, you're like making fun of it. You're like, he's got an axe. He's in the closet. You're dead. And that's exactly what's going on right now. So it's not about complacency. It's about settling into the fact that, well, we're in a very volatile marketplace. But again, I think you're in a situation right now that you're about to see shock and awe when it comes to volatility. And you got to get prepared for that. And again, I'm telling you, how do I prepare for it? Why do you think I'm talking about my risk? Why do you think I'm talking about how I'm flattened out on Delta? Okay, I don't want to sit here and take a dramatic amount of directional risk, especially with premium selling. Okay, when I'm telling you right now that you're sitting at a 26 fix, that little sucker could cruise into the mid 30s next week. Okay, in moments, and that's what that shock kind of comes is all of a sudden shock and awe. People that are actually caught naked short in puts are going to feel some pain, and that is why again hedging tight, wrapping up my risk, and I'm comfortable. All right. So some other issues exist in the marketplace right now. What are some of the other issues? One of the big ones right now has to do with the volatility inversion. If you haven't seen this lately, here we are on Tastyworks and looking at the 2 versus the 10. So I'll make this just very, very clear. The 2-year in here is sitting roughly, apologize for that. The 2-year, I'm going to use another pen over here, is sitting at 3.8%. I'm just rounding, it's 3.85%. The 10-year is sitting at 3.4%. That's actually some of the largest inversion in terms of the Treasury marketplace since the 1980s. And this is something I believe is going to continue to grow and grow substantially. The deeper the yield curve, inversion over here, which is, again, this is categorically speaking, pretty big right now. Again, we have to go back basically 40 years to actually see an inversion of this magnitude. It's disconcerting. But what's even more disconcerting right now is the fact that the bond market, okay, actually did crest the lows today. I mean, this is a pivotal marketplace, and the pivotal marketplace, I don't have a great feel for this. Again, I initially believe that bonds could sell off. And if bonds start to sell off, it's going to break the back of the entire marketplace, meaning like literally snap, volatility explodes, bonds sell off. And then all of a sudden, the trade in the bonds that sparked the sell side activity, the bonds are going to reverse and they're going to rip higher. That's actually my opinion. And I'll tell you exactly why the bonds are going to rip higher. I think the bonds initially sell off, okay, spark fear and loathing inside of the marketplace, and then turn around and burn back to the upside. When I mean that they burn, they turn and then they rip back to the upside. Why are they going to rip to the upside? Because people are going to use them as duck and cover. Where it's all of a sudden you're rocking back and forth into your desk, you go, I guess I'm just going to buy bonds. I mean, capital is going to have to flow somewhere, and that's disconcerting. The other one, which I've talked about just till I'm blue in the face, is the dollar. I mean, the dollar, okay, is that cause for concern? Yeah, you better believe it. It's a hop, skip, and a jump away from breakout to 111. A breakout to 111 is yet another factor that can snap the back of this marketplace. So you start looking at like some of the factors in the marketplace, like overall, like what do you have in the marketplace that's going well? You really don't. So you've got dollar, that's going to be a risk, okay? You got vol futures, that is clearly a risk, okay? You've got bonds. Now, which bonds do you want? You want to talk about the bonds or the treasuries because, you know, they're totally inverted. That's going to be a risk. Then on top of it, you're constantly seeing these 2 sigma moves. That's going to be a risk. You start compounding this stuff, okay? And it's just, there's not a lot of good places to go. Even if we rally back up to what? Oh, I don't know, 39, 31. We'll rest there for a couple of days. Okay, we're going to be facing some really fierce marketplaces, you know, marketplace and trading days all throughout the course of next week. And forget about the fact that, you know, everybody's going to be talking about the economic calendar. Okay, what's going to be on the economic calendar? All right, and again, who cares? It's the FOMC announcement. Yeehaw! So the marketplace is looking for 75 basis point hike. Yeehaw! Okay, maybe they're going to talk us off the cliff, maybe not. Again, if anything, I think that some of the fear and loathing come into the market on Monday or Tuesday. Be careful next week. Don't think that we're just going to wait to Wednesday. And the reason I'm saying that, I'm going to further that, okay, the last thing I'm going to discuss here, well, is the SPX. Once again, the SPX, the expected move for next week, okay, is definitely elevated versus this week, right? When I say it's elevated, so we're sitting right now at $118 anticipation movement. And I want to handicap that exactly on this chart. And I'm going to tell you exactly why I'm going to do that. So we're coming off a week right here, okay, that we were looking for plus or minus a $97 move. That was this past week. Well, the actual move, okay, is somewhere near like 200 points. We went down 200 points this week. Again, I don't care what, there's 9 minutes left in the day. The S&Ps are down, yada, yada, yada. We're going to end down almost 200 this week. Check, got that one. So all of a sudden, you have this $97 expected move. We move 200 and they go, don't worry, the Fed's coming. What are we supposed to move? Oh, plus or minus roughly 118. Okay, that does not leave me warm and fuzzy. It just doesn't. Okay, and I'm telling you right now that there is some decent amounts of risk, like earlier on in the week. When I say early on in the week, like Monday, they have it assigned like to a nothing volatility, like 18. And then you look at, like, by the way, there's a Monday, a Tuesday, you know, a Wednesday, a Thursday, a Friday expiration now. But the first day that they're actually displaying quite a bit of risk packed into the marketplace, unfortunately, is the FOMC meeting. And I'm telling you, I look at this Monday and Tuesday expiration, ruh-roh. I mean, the volatility is showing like a $50 move. $50 move is nothing on a day like today. So again, the SPX just screams like those volatilities look really low. All right, this volatility looks really low versus well, we've had the propensity to be able to move lately. Okay, that is again marked up all over your SPX chart. So again, because we have still 7 minutes to go to the cash close, I don't have a definitive expected move yet, but you can anticipate, and I'll have that out on this weekend. You can absolutely anticipate that you're looking at $118, $120 of anticipation and movement, which again, it seems inherently low. Even if we end up inside of that $120 move, okay, you think about that. Would you want to sell a $120 expected move knowing the Fed was coming out? Would you want to sell a $120 expected move knowing that we just moved about $200 this week? Okay, this is pure and sheer chaos right now. Okay, get prepared, wrap up your risk, be comfortable with whatever you have on. I mean, the one parting thing to you, okay, come into this next week, if you will, a little underallocated. What's the worst that's going to happen, right? If we rally back up, you're like, oh man, I kind of feel like I might have missed what? An opportunity to get your head lopped off? Because on the flip side of it is, a lot of people are probably going to be looking for the quintessential rip your face off rally. You don't get it. It's going to be vicious to the downside right now. So keep your hands and feet inside of the vehicle at all times this next week. we are ready to rock. Be prepared for the coming volatility shock. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.